I'm ready.
Hello, everyone, and welcome back to Black Digital Media TV. As you know, I'm Laurent Barber, and thank you for everyone that's tuning in with us. I have my usual lovely co-host, Gina. How are you today, Gina?
I'm doing well, Laurent. Thank you.
Good. We have an exciting guest. Everyone always know that's how I started out. That's my favorite word. I don't know anything to what else to say when I talk about the guest that we have on. I'm excited about this show. I've been looking forward to it because we have an excellent professional guest on with us today, Mrs. Mrs. Kerr, Seleka Kerr. How are you today, ma'am?
I'm fine, thank you. How are you all?
Good.
Glad to be
We're
here.
doing good. Good. Thank you. Well, listen, we're going to be talking about some of the best tips, things and ways if you're interested in buying a house, if you're renting. We brought on a true professional, and this is her expertise. Mrs. Kerr, she's a forever agent with Berkshire Hathaway. And so we're going to get right into the show. We know everybody, that's what you're waiting for. I'm going to turn it over to Gina. Gina will finish introducing Seleka, and we'll get started with the show. Thanks, everyone, for being with us. Gina?
Thank you, Laurent. Seleka, thank you so much for accepting my invite to be here. When we were looking for a real estate specialist, you were actually recommended. And even though I knew you from church, you never popped into my head until somebody else mentioned. So thank you so much for accepting the invitation. I know that you have a lot to share with us. And for those of you who are watching, if you're watching from Facebook, let's do some housekeeping here. If you're watching from Facebook and you want your comment to show here, make sure you give StreamYard permission by going to streamyard.com/Facebook. And just basically give them permission to show your comments. And that way we can see them here and we can respond accordingly, especially if you have, some great questions about real estate and investment, that sort of thing. So just make sure that you all understand that's how this works. All right. So Seleka, how do we begin? Where do we begin?
Well, I probably should explain what a forever agent is, because that's not really a common term. And a forever agent means it's twofold. So Berkshire Hathaway is more interested in relationships with people. We understand that there are people involved in the transactions, regardless of what the transaction is. And so we're very relationship oriented. And I intend to remain with Berkshire Hathaway for the duration of my real estate career because our values are so tightly aligned. And also, my clients that I have, I keep them forever. So once we have a transaction, we do any kind of transaction together, I will always be around to answer any questions. I will check up on people. For example, I had a couple close a few weeks ago, and their first mortgage payment will be May 1st. And what most people don't know is that there's something when you buy a home that you receive called a Homestead Exemption on your taxes, on your real estate taxes. And if you own a home, people know that the homestead comes around a certain time of the year. Well, when you buy a new home and you're stepping into the position of being the owner, now you need to file for Homestead Exemption. You don't have to wait for that window to open. Once you make your first mortgage payment, you can then immediately file for the Homestead Exemption. So I just texted my buyer the other day to let her know that she can do that. And on May 2nd, I'm going to text her again and say, don't forget, you can file for your Homestead Exemption. After you buy a home or you buy an investment property, you will continue to have questions and needs. And it's important for the person that you walked so closely with to make this major investment that they're still available to you. Because while real estate is one of the most profitable industries out there, it's not about money, it's about people.
So my question is...
Well, that's good to know because,
Go ahead,
Go ahead,
Gina.
Laurent, go ahead.
Yeah. So one of my first questions. So you talked about filing for the Homestead Exemption. Can you give a little bit more details on actually what that actually means?
So every county has a property appraiser.
Yes.
And so, or I should say in Florida, everything is driven by counties. in other parts of the country, it might be through the city. It depends on how your local government agencies are set up and who's running the municipality. Okay. So whatever your local governmental municipality is, who's responsible in collecting those real estate taxes, everything pretty much is online. So you can go to their website and put in Homestead Exemption, and the page will actually come up where you go to file. So that was the other thing I did for my buyer. I just sent her the link. So you don't even have to think about it. Just go to the link and it'll take her right to the page that says, if you want to file your homestead exemption, you can do so right here. And all you do is put in your name, your, the home address, and whatever else they ask you, because your mortgage will at that point be on file, and they should be able to find that, okay, you are indeed the owner of record, because the deed would have transferred. Because it takes, after you purchase a home, it's about 45 days until you have your first mortgage payment. And part of the reason for that is your account being set up with the mortgage company, as well as everything being registered with your local municipality.
All right, so let's talk a little bit about the current trend, because I noticed that the current trend is what we call multifamily okay. properties. Mm-hmm. So explain a little bit about what that would entail. So or what that means when you say multifamily. Okay.
So multifamily, in the simplest term, means that there's more than one family in a dwelling. Now, that can mean different things in different parts of the country. So in the Northeast, for example, or in any of your really major cities, there's a tendency to have things called duplexes, where you've got one physical structure, but they're divided down the middle, and you can actually have two residences. They're typically identical in size and layout. And those are also considered multifamily, because one person can own both and then rent out the other side. Sometimes they are, instead of being side by side, they are vertical. And so there's somebody on the downstairs and there's somebody upstairs. It just depends on however the structure was built. Then multifamily can also mean, for those who have multi-generational situations in their family, where maybe the grandparents are living with their children, and their children also have children. So they're all under one roof. And so what I've seen here in Florida is where there's one pretty good sized home. And sometimes I've seen them with a 3-car garage, where the 3-car garage is split. So there's a 2-car on one side, and that goes for the primary family. And then there's a single-car garage with a separate entrance for whoever is living in the multi-generational side. And that side would have its own kitchenette, living space, and a bedroom. So it just depends on where in the country you are with what type of multifamily dwelling is actually available. You don't see as many duplexes in Florida. They do have them, but they're kind of few and far between.
So is the purpose a lot of time for multi-family dwellings? Is that for the purpose of everybody sharing to pay for that rent? Or is it that one person, if it's an investment property, that the owner lives in the property while they rent out the other side of it? Is that how that normally goes?
So it can be, so for example, my brother and his father had one in Philadelphia. So his father lived on one side and he lived on the other. Both of them owned their particular sides, but really his father had owned the entire thing, and he ended up selling the other side to my brother instead of renting it to him. But what happens is that if it is an investment, then yes, you are renting out the other side if you're the investor, and you are charging them whatever the mortgage is plus, so that you have money to cover incidentals, accidentals, those types of things that are going to come into play when you have a property.
So how does the bank, if you wanted to invest to an investment property, how does a bank view that situation? If an individual goes and says, hey, look, I want to look at a multi-dwelling unit, what kind of structure, financial banking structure is considered for that particular person? How does that What would you recommend?
That's a really good question, because there are different loan types and you cannot use all of them for investment. So for an investor, if the investor doesn't have cash to pay for the whole thing, then an investor would be looking at some type of conventional loan. And so a conventional loan is one that is not backed by government assistance, because there are loan types that are backed by the government, and a lot of people use them because they have more forgiving standards that for you to be able to meet in order to qualify. For a conventional loan, you need to have a stronger credit score. And if your credit score is not as strong, then your interest rate is not going to be as low as it would be with a government-backed loan. So what a bank is going to look at is the investor's credit score, their assets, their ability to pay. And if it's a situation like a duplex, you'd be buying the entire building, and they're looking at the investor's ability to pay for that on their own, because they have to consider at some point you may not have a renter, or in a situation like a pandemic, you've got lots of investors who had renters who were negatively impacted and lost their jobs and couldn't pay the rent. So then the government is saying, well, you can't evict them. So now the investor has to carry the weight of that mortgage with minus the renter's payment. So those are the things that they're going to consider and look at.
So I have a question. Does everyone who come to you, are they ready to purchase, or do you work with people who may say, okay, I would love to be able to purchase a property, but I'm not quite there yet, maybe because of their credit score situation? Do you work with people to build up until they're ready? And if you don't, then what's the procedure? What do you usually recommend for them?
So Gina, that's a really good question. I'm glad you asked me that. So I have people that I have walked with for years, getting them to the point of being able to purchase. So, for example, there was a couple that I worked with that they just closed in November. And I had been walking with them for 3 years. They had to, get some things in order. And because it's not always that someone's credit score isn't high enough. So, because your credit is, and your credit worthiness is built on a number of factors. So in this particular case, the wife was in graduate school. She was working on a doctorate. So while she was in graduate school, she didn't have enough income. She and her husband didn't have enough income to qualify to buy what they wanted. So what they worked on was paying down debt and saving money. And then once she graduated from school and she found a fantastic job, she was able to then be on that job. They'd like you to see you in your position for at least 6 months to show stability. And then once they had filled all those requirements, they both really were able to be pre-approved to buy. And so when she got the green light, then we went shopping for a house, and they ended up having a house built. And the irony was that this is one of the beautiful things about if you're buying a home and you build. So if you're patient enough, and patience is something you really need to have when you're dealing in real estate transactions. If you're patient enough that you can wait the 6 months, things can work in your favor like they did with them. So they got pre-qualified at a particular interest rate in the middle of the pandemic. And because of the impact of the pandemic on the economy, mortgage rates dropped to record lows. So by the time we went to close, their mortgage payment had dropped several $100s. And so when they locked in the interest rate, it was, I think, 2 full points lower than what they had pre-qualified for.
Wow, that's a huge significant difference, 2 points. So
Yeah.
when you say they pre-qualified, what does pre-qualified actually mean for someone that's really getting what does that mean versus being approved for a loan? What is that the same thing, pre-qualified and being approved? What's the difference between those two?
So a pre-qualification is like skimming the surface. So we're going to capture some basic information and look at your credit score, but we're not going to do a real deep dive. And it's kind of somebody looking and giving a real cursory look and saying, okay, you can buy. A pre-approval is where they're going to ask you for everything, including your firstborn. And they're going to look through bank statements, pay stubs. They're going to, if it's a really good lender, they're going to review your credit report, looking for everything that they know that underwriting will ask them about. Because a lot of the horror stories that you hear about people that were in the middle of a home buying purchase is around, I was about to close and all of a sudden here came X, Y, and Z and I couldn't close. So a lot of the time, those red flags are already in the credit report. And if a lender is diligent enough to say, let me look and say, okay, you need to pay this down. You need, what is the history of this right here? Can this get resolved? You have a tax bill that needs to be paid off, or you need to be in a payment plan, like whatever. They can tell you all of that before they give you a pre-approval and before you go find a house and get your heart set on it and pack your stuff up, only to find out that, oh, I can't close. So a pre-qualification and a pre-approval are very different. I always have my clients get a pre-approval. I don't mess around with pre-quals at all.
Wow. Okay. So actually also, so let's talk about credit score.
Okay.
So if someone wants to, so what's the best time for someone to kind of consider looking at their credit? Is that something that they can do on their own? If there's some issues, do they have to go out and get someone to help them get things off of their credit to get their credit score better? Or is that something that they can actually do for themselves? But what would you recommend? And when, if you decide you want to buy, when should you start making sure your credit score is, and what is considered a good credit score when you're looking for a rental or property in any regard?
So right now is always a good time to look. And it doesn't matter when you want to buy. As soon as you start thinking about, this is the thing I want to do, it's important to then at least check your score on something like Credit Karma. Credit Karma is not going to be exactly what a mortgage lender looks at, but it's going to tell you where your credit score falls. And for people who have more challenging credits, say below a 600, you might see that some lenders will say you can still buy a house. And that sounds good. But the benefit of the credit score is equivocated to your interest rate. So the higher your credit score, the lower your interest rate is going to be. And it's the interest rate that drives the payment. And so one of the things that handicaps our culture is that we are payment shoppers. And so if you shop by payment, you are always going to get handicapped, particularly like if you're shopping for something like a car. Because if you tell somebody, if they ask you, well, how much, are you looking to pay a month? They're trying to string you up. You need to ask them, what's the interest rate? Because the interest rate drives the payment. Mm-hmm. And when it comes to a mortgage is made up of a formula of, it's comprised of certain factors that are equivalent to your actual mortgage payment. So, and most of them are impacted by your credit score. So for example, your principal and interest is going to be absolutely set by the credit score. Your homeowner's insurance is going to be impacted by your credit score. That's one of the factors that's going to impact how much your homeowner's insurance is going to be. And then the other part of your mortgage payment could be an HOA if the community has one, and the taxes. So taxes are whatever the taxes are for the area that you're looking at buying a home. So certain parts of the country have lower taxes, certain parts have higher taxes. Like New Jersey has very high taxes, but those things all are put together to add up to whatever your total mortgage payment is going to be. If you are putting down less than 20% on your home purchase, then you are also going to have to factor in something called PMI. PMI is the brainchild of the market crash. So when the market crashed before, there was no protection, if you will, for the banks. So if people suddenly didn't pay their mortgage, they had no way of recouping the loss. Now, PMI stands for private mortgage insurance. And I thought that was a little ridiculous on my consumer side, because the bank is going to get the building back. You're going to get the house back and you're going to be able to sell it. The consumer is left without their home and have to find somewhere else to live. But they instituted private mortgage insurance for people who put down less than 20% on a conventional loan. With a conventional loan, once your equity in the home gets up to 20%, then the private mortgage insurance can go away. Some mortgage companies track it and they'll let you know you're at the 20%, you don't have to pay this anymore. Others, you would have to actually be watching that for yourself and then say, hey, this needs to go away. With an FHA loan, government-backed loan. So with FHA, there's PMI for the life of the loan. So that can play itself out in two ways. So for example, my husband and I are having a house bill right now. We are using the FHA loan. And so there will be private mortgage insurance tied to our loan. The interest rate we got is so low that refinancing into a conventional loan to get rid of the private mortgage insurance at some point would actually make my payment go up. So you have to be strategic when you look at the numbers to understand maybe this private mortgage insurance isn't so bad because the interest rate I'm paying is so low that the private mortgage insurance really isn't hurting me. And anybody at any time can do something called accelerate your amortization schedule. Mm-hmm. It's an amortization schedule. The amortization schedule is the schedule of payments for the 30 years for your mortgage. And so if you only make one extra payment a year and you send it to the mortgage company, like say you get your tax refund back and you're like, okay, we got a few $1,000s back. You take that and you make one extra payment and you tell your mortgage company, this is going on the principal. You can cut down on the life of your mortgage by 12 to 15 years.
Wow.
Yeah.
That's incredible.
It is incredible. It is incredible. Make sure that when you get your loan, so like if it's an FHA loan, this won't be an issue. They're not going to have what's called a prepayment penalty. Yeah. That was another thing that was big in the crash, that a lot of those predatory loans, they had these prepayment penalties. So you were locked into those mortgages and the only way out was to sell your house. Yeah. There was no ability to pay your mortgage down sooner or, accelerate that schedule and pay your home off faster. No, but you can do that now.
So let's address the question about credit score. What can someone do to work on their credit, to get things off? What should they begin to do? Do they need to pay someone to look at their credit, or is that something that they can actually do to monitor and work on things themselves to get things off to make their credit score higher? Because sometimes people always say, oh, a company says, come to us, we'll get your credit score good. but do an individual need to go to them, or is it something that individual can do for themselves?
So you don't have to go to a company. Full transparency, there's a company that I do refer people to for that, because most people don't have the time or the knowledge to do all of the challenging of the things on your credit that need to be done. So because by law, there are certain things that are violated by the companies reporting to the credit bureaus. And they know it, but most consumers don't know it. And even if you did know, you don't know how to go about challenging it to get what's on there that's not right corrected. So you need to find a reputable company that can do that, because they can challenge medical claims. There are different things that get placed on your credit report that really shouldn't. But again, most consumers don't know that. The other thing is that you don't have to pay someone. And sometimes there are small things that you can just take care of yourself, whether it's coming up with a payment arrangement. Everybody's situation is different. I would say the larger the problem, the more likely it is that someone would want to hire a company to go after the creditor who's claiming you owe them, or that this or that, because that whole world of collections, all they do is sell those things for pennies on the dollar, and they'll come after you because a lot of people will pay, and that's how they make their money.
Yeah, I noticed on Credit Karma, they actually make it very easy for you to dispute certain things if you know what you're doing, right? And it's really not hard. For the big things, yes, I would recommend, hiring somebody who actually knows what they're doing and not going to rip you off just to make a quick buck. But I did have a question about that though, because I use Credit Karma to check my scores. Yeah. And my question was, which particular credit scores do lenders usually look at? Because I've noticed there's a big difference, like a 30-point difference between TransUnion and Equifax.
So the whatever institution is pulling your credit, they're going to look at the all three. But because what they do is they look at all three bureaus and they take your mid score, and mid means middle. So if you have a 650, a 670, and a 630, they're going to go with the 650 because it's in the middle. So the what's different is that what you see on Credit Karma is not the full scope of what a mortgage lender is looking at when they pull your credit. So all Credit Karma is really showing you is credit cards, car payments, student loans, that kind of thing. And when a mortgage company pulls your credit, they're looking at rental history, if you have it, if you've ever owned a home before. And the way that their score is configured is a little different too. So sometimes Credit Karma is a little high, sometimes it's a little low. I've seen both scenarios.
So what happens if you have a landlord who doesn't, because you mentioned rental history. So how do they pull rental history if you have a landlord that never really reported?
So what would show up is if you were ever evicted. But the rental history, you can pay to have that reported to the credit bureau. And I think you can do it with some of the utility companies as well. So you pay a monthly fee and they will report to the credit bureaus.
Well, that's interesting.
Very.
So let's also talk about Seleka, as far as first-time home buyer. What is considered a first-time home buyer?
So a first-time home buyer is either one of two things: someone who's never bought a home before, or they have not had a property in their name in the last 3 years. So if you owned a property, so if Gina was wheeling and dealing 10 years ago and she had 17 properties and then she sold them all and she decided now to buy again, she is a first-time home buyer all over again.
That simple, huh?
That simple.
Wow. So what is there any advantages if you're a first-time home buyer or if you've rented before? What is there any advantage, and what are some of the advantages, or what's available to first-time home buyers if that's their first time?
So first-time home buyers, this is another good question. It's like you're reading my mind. So, so first-time home buyers have to be careful, because what they will see is, oh, well, there's money available for me, or they've got programs for me. And that is true. And the programs vary depending on where you are in the country. Now, the fine print to the first-time home buyer is the interest rate that you will pay. So sometimes you have to be very careful before you get excited about, oh, they're going to give me, $10,000 or $8,000. You have to be careful and read down to that fine print to see if it says interest rate 5.75. And now that the interest rates have gotten so low, interest rates at one point were as low as 2.2. So if I'm a first-time home buyer and I could get money for being a first-time home buyer, you have to weigh, for example, if the interest rate, so say just on your credit score, you could get a 2.5. But if you go interest rate, but if you go through the first-time home buyer program, now you're at 3.5. You have to look at the difference of what that 1% is going to cost you per month. And if you intend to stay in the house forever, which most first-time home buyers don't, then you'd have to look at it over the life of the loan. So first-time home buyer, and they sometimes have very stringent requirements. So I've seen them with requirements like 700 credit score or 720, or above, and they'll tell you how many years you had to have been nearly perfect with your payment history. And, there's just a lot of different things. And sometimes there's even income constraints. So you can't make but so much money to be able to benefit from the first-time home buyer program.
Okay.
That's good. We have a question in the feed. Eugenia Harris is asking, is it true that with FHA loans, when buying a multifamily property, that the buyer only has to live in the property for 1 year?
No, ma'am. So one of the rules with FHA is that it has to be your primary residence.
Okay.
And so does it have to be your primary residence for a period of time or throughout the entirety of that mortgage?
Throughout the entirety of the mortgage.
Okay. Mm-hmm. Wow.
So if you buy a home like that, FHA, to get in with the interest rate, and then you find yourself in a position where you want to turn it into an investment, you'd have to change the loan to a conventional.
From FHA to conventional?
Yes, you'd have to refinance.
And how long does that take?
To do a refi?
To change it from a FHA to a conventional, is that depending upon the lender that you're working with?
So typically, now before the pandemic, you could get that done in about 30 days. Now, because there's been so much activity, because the interest rates have been so low, it could take 45 days. So it's not a real long process.
We have another question from Reginald. I believe that's your husband, isn't it? Right, from Reginald Kerr. How does Homestead benefit the homeowner?
So the Homestead benefits the homeowner because it gives you a credit against, okay, so let me back up. Your taxes are generated based upon the value of the home. So there's an assessed value. So your Homestead gives you, for example, it could be $25,000, it could be $50,000, that they credit the homeowner so that they assess it on that much less. If you are renting the property and because you're using it as an investment, then you don't get that homestead. And so what you pay in taxes is significantly higher. Thank you,
All right.
Mr.
The name hit me. It's like, oh my gosh, that's pretty. Right, so I have a question written down here, and I've had it written for a few minutes. Okay.
Okay.
I know that the title of this is "Why Rent When You Can Own," but are there any circumstances in which you would recommend a rent to own?
So rent to owns are, if they're done privately, or again, you have to be very careful. And you absolutely want to get an attorney involved in the document that is being written and in the understanding of the terms. There are a few companies out there who, what they do is they will buy a property for you and allow you to rent it from them, and you come up with and they give you up to 5 years to buy the house. So what they do is work out for you what your rental payments will be each year, and the rent will go up each year. And the rent is higher than what the mortgage will be, but they predetermine what all those payments will be and what they will sell the house back to you for each year that you are in the rental situation. So those companies really came to light after the market crashed, because there were people who had cash and not enough credit to be able to buy. And so they work really well for certain people in certain circumstances. If you have the discipline and know that, okay, we've got $20,000 that we've saved up, and we can go into this situation and it'll cost us about $5,000 or $6,000, in fees, which is very similar to what you'd spend by the time you pay first month, last month, blah, blah, blah. And then we'll put the rest of this money to the side, work on our credit. And then in 2 years, we're going to buy the house. At least now we've been living in the house and we can really treat it as our own, do whatever you want to it. And just with the understanding that when the 5 years is up, if you have not purchased that house, then you are not, that money that you have spent, you're not getting back in terms of that home. You're going to have to move on and figure out something else.
Wow.
Okay.
So let's talk about individuals that may have, Seleka, that may have gone through a bankruptcy on their particular credit, and they're kind of concerned about that situation. Can you speak to someone that's now interested, but they says, hey, I may have a bankruptcy? What would you say to that person at that point?
So you want to find a lender who is able to walk you through that process, because having had a bankruptcy doesn't mean you can't ever own a home again. So there's a window, and I'm not as familiar with how many years it is before you can purchase a home again. And I do know, though, that it is tied to the type of loan. So it is possible, but what you have to do is land on the right lender. I work with a lender. Hey, Joe Andrews, if you're watching. I work with him all the time, and he's phenomenal. And one of the couples he referred to me was a couple he walked with for a year, and he walked them out of a bankruptcy, and they were able to buy.
Just out of a year of them having gone into bankruptcy? Or
I know he worked with them for a year. I don't know at what point they filed the bankruptcy.
Right.
But they're in that home today. And the same day we met, we wrote a contract for a brand new house. Wow. So, and he was a veteran as well, which also helped him, because a VA loan is also a government-backed loan. And we like to take care of our armed services, men and women. And so their loan really provides a lot of supports for them. But yeah, the first thing they had to do was work on the credit, and whatever the time frame was that it needed to be from the time the bankruptcy was filed until you can buy again, he worked with them, and then they were able to buy.
So we have another question.
Okay, go ahead, Gina.
What is your take on NACA?
On NACA. So what I will say about NACA, I have been to NACA meetings and training. I have talked to people here in the city where I live here in Tampa. And NACA is a phenomenally constructed program. The success of the program, from what I have seen and with people that I've talked to. So for example, I know one couple, it didn't work out for them, and not because of the program itself, but because there were some turnover issues in the office. So they didn't have a consistent kind of, whoever it is, the provider that works with you, like your case manager, if for lack of a better term, that kept turning over. So they never really got any traction. But then I talked to another buyer. They walked her all the way through, and she's closing on a brand new home in a few months. So it's like anything else. Some situations work really well for some people, and some situations don't. So but I am very familiar with the program. And one thing I will say that is tremendous about them is they really walk you through your expenses and understanding what you can and cannot afford. Mm-hmm. But it's also, again, requires a lot of patience, because it's not something that they're going to turn around and you're going to be in the house in 3 months. It really takes some time.
So what does NACA actually stand for? What kind of program is that?
I don't remember what NACA stands for, but what it came from is from the market, the housing market crashing. Oh. And there were banks like Bank of America, JP Morgan Chase, and others that had and sold so many of these predatory loans. And there was such an impact to consumers that those banks were challenged to come up with a way to go back and help these same people that were so harmed by that entire thing. And so it was birthed out of that. And one of the things that they do is one of the banks, I think it's Bank of America, actually, that they do all the mortgage loans for NACA. And so they lock in a low interest rate. And I mean, it's very beneficial if you have got the ability to get to the end and cross the finish line.
Okay.
For those of you who are wondering what NACA means, it actually stands for Neighborhood Assistance Corporation of America. So you can just type that into a Google search. That's what you'll find.
Okay.
Thanks, Gina, because I couldn't remember.
Yeah, I never heard of that term. I have not heard of that particular program. So you did mention predatory lending.
Yes.
Seleka, can you kind of shed some light on what that actually mean, and how did that kind of start? If someone's saying predatory lending, what does that actually mean?
See, that's another good question. Because with the way that the market is booming right now, that is a fear that people have, is that the market is going to crash again.
Really?
And yes, but there is the dynamics that were at play when the market crashed before are not at all what is going on now. So with the predatory lending, there were a few things that were happening that are not allowed to happen anymore. So one of them is something called a good faith estimate. So, because this happened to me twice. So I have lived through this twice. Yeah. I bought 2 properties and lost both of them because I was locked into 2 predatory loans. And so I have firsthand experience in what this feels like. And it's also one of the reasons why I care for my clients the way I do. The good faith estimate said it would give you an estimated payment, and it would give you an estimated interest rate. And there's a certain point in a purchase where your interest rate gets locked in. And what lenders were doing is they weren't necessarily locking in the interest rate But they would tell you, yep, this is your interest rate. And they would put it on this good faith estimate. And there were all these other numbers on there. And so first of all, if you're not a finance person, you don't even know what all these numbers are.
Right.
And you think, okay, so and what people do, we're payment driven, remember, right? So what you do is you go down to the bottom of the page and you say, okay, well, there's my payment right there. Okay. And so then, and this happened to me exactly. You get to the table, and I had what was called a first and a second mortgage. This was very common back then. And the second mortgage, they gave to me to sign that one first. Now, I don't know the difference between a first mortgage and second mortgage. All I know is I'm walking out of here with some keys today and I have to sign these papers. So that's all I'm really concerned about as a consumer. And the agent that I had did not inform me. And certainly the lender didn't, because they're preying on people. So they just told me this is what you need, and you'll have a first mortgage and a second mortgage, and it'll make your payment lower, something. Okay, sounds good. So I signed for the second mortgage. It was the same interest rate they told me it was going to be. Great. Now they hand me the papers for the first mortgage. The interest rate was a full % higher than what they had told me. And so now my payment was more than $100 more than what they said. And because I was the uninformed consumer, I'm thinking I've already started to sign, so I have to keep signing. My realtor was sitting right there. She didn't tell me the second mortgage rides on the first. If you don't sign the first mortgage, the second mortgage doesn't exist.
Wow.
So really, I could have gotten up from the table. Now, it would have been an inconvenience in terms of I had already, given up my apartment. I got stuff in boxes, but that is light years from the horror of a second foreclosure and all the trauma that, goes with that. So that was one of the things that they did, was the good faith estimates. They would tell people their mortgage payment was one thing and then come back and it was something completely different. So now there's something called truth in lending.
Okay. And
the lenders cannot play that game anymore. And if there's a situation like that, they can be very heavily fined. And, somebody like me is going to holler, that's not what you gave them. So now what happens is the buyer gets a copy, and then your realtor should get a copy too, so that we're all evaluating the same document so that we can ask any questions that need to be asked. The other thing was the what they call an ARM. So an ARM, where are these mortgages where the ARM stands for adjustable rate mortgage. So what would happen is that you lock in a lower interest rate for a short period of time. It could be 3 years, could be 5 years, and then the rate is going to adjust, and it could adjust every month. So your payment is no longer stable. And the mortgage that I had, I was figuring I was going to be able to flip like everybody else had. So I buying a place, I renovated the kitchen and the bathroom, and I said, okay, I'm gonna stay in here for a hot minute, and then I'm gonna sell this, get my big chunk of money, and put it on my student loans. And instead, 2 months after I signed, the mortgage crashed. The market crashed. Yeah. Wow. So the adjustable rate, when I saw it and it showed me what the first payment could likely be, I really wasn't concerned, because again, I said, I'm going to be out of here. I'm going to be in here for 2 years, and then I'm going to sell it. And, because that is what everybody had been doing. And the momentum was crazy, because people being able to sell their house, get a ton of cash out of it, and turn around and buy the bigger house and have the same payment or even less because of the equity that they had gained.
Right. Yep.
The market was just going crazy. And so the greed that came out was unbelievable. And the banks knew that what they were doing, that basically these loans were garbage. They knew it. So they knew that they would package these loans up and then sell them to somebody else. And then they'd make a profit and then just start the whole thing over again. And so while loans are still sold, from bank to bank, what they are no longer doing is those good faith estimates that are not accurate. And they are also not putting people in loans where you have a prepayment penalty. And they're also not putting people into those adjustable rates without the buyer really understanding what it is that they are stepping into. Because like the lender that I said I work with all the time, Joe was doing loans back then. He never put anybody in those loans. So it's really important that we live in the information age, but information is not the same as representation. And everybody who has a license in a particular field is not going to give you the same level of service or information because everybody's motivation is different. And if their motivation is money, then you are at risk. You want to deal with people who are operating in integrity and in excellence, and that understand that you are a person before there's a transaction.
So basically, with the good faith estimate, the properties that you bought, that you were kind of, you signed 2 mortgages, and the real estate agent didn't necessarily say, okay, you had an option. You could have just not signed the first mortgage and you would have been able to get out.
Right.
Was there no repercussion back then, even again with the agent? You were basically kind of stuck. That's what you were saying? So
right.
Things are different now.
Right.
Okay. All right.
So Seleka, also speak to, because look like I froze. Okay, look like I froze on you right there. But speak to the title, because it says why rent when you can buy. Okay. Can you kind of go into that a bit at this point as well? What's the advantage of, if you're paying this much, how would you say to a person it's more better for you to consider buying than renting? What would you say to that person or that couple at this time?
So the thing with rent is that you are basically paying somebody else's mortgage. If they even have a mortgage, if they own the property outright, you're just truly another stream of income for them. And there's no financial benefit to you, the renter. So it's money that you're just giving away. Now, yes, there's a need for renting, but you want to make that be as short a term as possible. And too often what happens is people get comfortable in the renting situation. It's, ownership is a kingdom principle. And so if you don't have a mindset that is about owning and walking in some form of dominion, then you're just going to think it's okay that I have a rent payment because this is just what I do. So when you buy, if you have a mortgage, yes, you are paying that mortgage payment to the bank, and the bank is holding the note, but you are getting benefits like homestead exemptions. You're getting a break on your taxes. There are other things that you can write off when you file taxes because you own a home. For example, I had a couple, they bought a home. The home was brand new. And when the mortgage payment was calculated, remember I said taxes is included in that calculation. Well, when it's a brand new house, the only thing the county has on record, or your local municipality, if it's a brand new home, all they have on record is the taxes for the land. When you add a house on top of land, the taxes go up significantly. So I'd had a conversation with the lender, and I asked them to make sure that they really escrowed, and escrow is another way of saying save money and put it to the side for a future payment. Your taxes are escrowed; they're put in an account, and every month, as more payments are made, the account grows until the tax bill comes due, which is typically November 1st, and then the mortgage company makes the tax payment for you. So when the taxes come due, it's important that what the county is saying is due is what's in the account. In their particular case, there was an increase in their tax bill because some other land was purchased in the back of the community, and it caused an increase to the tax bill. So they get a tax bill that basically said their mortgage payment was going up by $1,000 because their escrow account was short. And so these are the kinds of things that also make people fearful about buying a home. But here is the difference when you own a home versus when you rent. If your landlord sends you a bill and says the rent is going up $200, $300, $500, that's what it is. Now you get to decide, am I going to stay there? A lot of people choose to stay because it's going to cost them more to move, because landlords want first month, last month, security, all of these fees. So they'll stay there and they pay the higher amount. There's no negotiating. In this particular case, their mortgage was held by a bank that actually sold it to another bank. And when the new bank stepped into play, I said to them, you need to go back to the lender and ask them, how can we restructure this? Because, you know, mortgage payment going up $1,000 is not even in the realm of possibility. The mortgage company refinanced their home. They got a lower interest rate than what they originally had. And their mortgage payment did still tick up slightly. But once they pay back the part that was in basically short, then their mortgage payment was going to be fine. That doesn't happen when you rent. And so ownership puts you in a position of, number one, is the first step into building wealth, because your mortgage payment stabilizes. So for the most part, your mortgage payment is not going to change. You may have some fluctuations because as the home gets older, for example, the insurance company that is holding your homeowner's insurance, they might raise the rate because concerned about the roof, or just as the house ages, things are more likely to happen. So they'll increase the amount of the insurance to basically equate to whatever they think that they might need to have put to the side to lessen their risk. But in terms of that principal and interest, that's not going to move. Like I mentioned earlier, you can accelerate your amortization schedule. You cannot do that as a renter. When you own a home and you build equity, whether you stay in the house and pay it off, or you choose to sell that house and go someplace else, you, the homeowner, get the benefit of the equity. So if you bought the house for $200,000 or $250,000, and like the couple I just mentioned, people across the street from them selling the same exact house for $350,000, you could choose. So now you've made money, right? You could take that money and go buy something else if you choose to. That will never happen, as you know, for a renter.
Wow.
Mm-hmm.
Wow. So definitely a person that's renting would definitely need to consider a lot of things to consider.
Right. And I've seen the pandemic, you know, and I'm a capitalist. I understand capitalism. I just didn't particularly, I didn't think this was particularly fair, but it is what it is. This is the market. So I've seen where now property management companies, before, your application fee might be $50. And if there's two of you, maybe it's $75 to cover the two people. No. Now we've invented fees. So we've got an administration fee that's $300. Doesn't go against the security deposit. It doesn't go, it's just another fee we're going to collect. So you have an administration fee, you have an application fee, and then we want first month, last month security. And then I just looked at this the other day. The average rent, I went on two different of your major property management companies that have homes all over the country. $1,700 a month was the average. And not, I'm sorry, not the average, was the lowest.
Wow.
And I'm talking about for 3-bedroom, 2-bath, nothing fancy, 11, 12, 1,300 square feet, nothing huge. So if you have to give first month $1,700, second month $1,700, and security $1,700, you are at $5,100. So then let's throw in a $300 administrative fee. We're at $5,400. So if 3.5% down on a house, a $200,000 house, is going to be, $6,000-7,000, you're already not that far from that.
Yeah.
So it's something to consider, because at least with the money you put down on the home, you're investing in yourself.
Right.
Because now the other thing I've seen is that when you go to move out, because they tell you, well, we're going to hold your security deposit, and then when you move out and everything's okay, we'll give you your money back. They're going to find something and tell you that you can't have your security back.
Wow. So if they say you can't have the security back, does that mean that they're going to keep all of it, partial of it, or what does that mean?
All of it.
That's a zero-sum game at that point, huh?
Correct. Zero sum. That's exactly right. Yeah.
They're like, really? You thought we was giving that back? Well, I don't think so, right?
We're gonna find something here that you did. We're gonna find it.
Wow.
So, but on the other side of it, I would also say, and I tell this to my buyers, you should think about investment. So if it's your first place and you're buying a condo or a townhouse, consider, when you're ready to move on from this, renting this out and let this make money for you. Because that's the other thing with home ownership. Your money is now working for you instead of working for somebody else. And if it's an investment, because you do choose to move out and rent it out, now you have a stream of income, and it's passive income. So what does passive income mean? You're not paying taxes on it. You don't have to pay taxes on that money. That is one of the reasons why real estate is such a way to build wealth, is that if you can buy investment property and rent it out, you're not paying taxes on that money. Listen, I didn't write the tax code. I'm good with it. But I also understand that it should not be a long range plan for anybody. The long range plan should be to own.
Wow. That's good. Gina?
Oh, I've been taking notes, busily taking notes. I'm learning a lot. And I've owned a home before, but technically now I would be considered a first-time home buyer because it's been quite a number of years.
Okay.
So yes, I'm sitting here and because I've actually considered renting, and that's where my mind has been for the last few weeks. But after listening to you, it's like, you're right. Yeah. Now we are at an hour.
Okay.
Just over an hour. We usually try to keep it to about an hour. But I know that our viewers are going to have a lot more questions. So we do have something in mind, right, LaRon?
Yes.
As far as bringing Seleka on as having her own segment. Because real estate is one of those topics that there's so many different parts to it, and we could not possibly cover it in an hour.
Yeah.
So, do you want to talk about that in a little bit more detail? Share that with our viewers, because we did have quite a few questions, and I know that there are going to be questions even following, once we get off here.
Yeah, well, definitely. Like I said, we've talked to Seleka, and I'm looking at definitely bringing on to the platform to where we can actually talk about these things. You actually mentioned wealth building as well too. So I want to focus on that particular segment as well too. And I think you'll definitely be a great person to kind of go into that part, along with the home ownership. What does it actually mean, wealth building, when you're actually starting to build and purchase homes? So we've asked Seleka to kind of stick with us and kind of help us out on that part. And talk about, be a part of a panel or just having a discussion where we're actually talking about what real wealth building, stocks and things like that. How do we get into that? But just definitely have a real business conversation around that and just kind of educate our community at this time right now. But I do have one question for you, Seleka. In terms of the pandemic, what effect has that really had at this point in time? Has that had any effect tremendously on the market at this point? What would you say to that?
It has had an insane impact on the market that nobody foresaw. I can tell you, I won't name the builder, but there's one, and I mean nationwide, significant builder, that when the pandemic happened, they were in the midst of building in certain communities, and they said, we are out. And they turned around and sold those lots to another large US builder, because they were anticipating the worst. And initially, when the pandemic hit, people who were putting their homes on the market, a lot of them withdrew, some changed their minds. And then for all of the lockdown, where people were no longer going out to eat and they weren't spending money the way they had been. So the market saw people who were stuck in their houses and decided they didn't like their home. The economy said people aren't spending money because everything is shut down. So we need to lower interest rates to stimulate the economy. So that's why the mortgage rates began to drop and drop and drop. And as the mortgage rates dropped, you compile that with people who've been home for 6-7 months, not shopping, not spending. They've been actually saving that money, that were in a position to buy. They came out of the woodwork. And because the inventory was so low, and home builders have gotten to the point that even those that were building inventory homes, which means we know people are shopping for houses and we just want to have some ready. So when they come in and say they want to buy, we can sell it right away. They went from that to, I'm only selling a house when I've got a contract for a house. And so it slowed down production. The cost of goods went up, and then inventory being tight and demand being high, supply and demand is what sets your market. So the prices for homes went up, and I've seen people made $100,000 in a year on their home because of those factors right there. It's like a perfect storm. One of the challenges, because there were people who thought that when the election happened, the market would shift and the prices would go down. And real estate doesn't work that way. So once the prices are up, the prices are going to stay up. There's not going to be this fire sale. And even as the foreclosure, the stay of foreclosures that the government and then the CDC came behind them and said, even once we come out of that and that is lifted, those foreclosures will just be absorbed by the market because there is that kind of demand. And so the pandemic brought a lot of things, but it really made the market go up in ways not seen ever.
Wow, I bet it did, yeah.
And mortgage rates lower than they have ever been. And that also pulled a lot of people to say, let me buy. And coupled with now that employers saw that people could work from home and they're going to continue to have them working from home, now I can live wherever and still keep my job. So that also inspired people to buy, and in some cases to move. There's a lot of influx into Florida because of that.
That's definitely one of the good things about the pandemic. Depending upon your job, people can actually live anywhere now and still do their jobs. And that's just amazing how the pandemic has just totally changed business, life in such a profound way. And I think companies are going to kind of somewhat keep that model. Why go back to where it was when they found a way to make it work? Absolutely. So, yeah. So
that home wave went out the window. Now people want big houses. And for others who didn't want to move, the demand for renovating through the roof.
Yeah.
Such a demand for that right now too. Mm-hmm.
Wow. That's amazing.
Yeah.
So tell everyone. Okay, go ahead.
I'm sorry. This just kind of popped into my head as she was talking. And I'm in Florida, obviously. Well, not obvious, but I'm in Florida. So there's a large, there are lots of pre-manufactured homes here. So for those people who maybe they want to start off in a pre-manufactured home, or because that's what they can afford,
right?
what would be the difference? Not sure how to phrase this. As far as the types of loans that they could get and particular fees that might be involved, because I know that in Florida there are possibility of tornadoes occasionally, then there are hurricanes and all of that stuff. So when a lender is looking at providing a mortgage for a pre-manufactured home versus something that's maybe brick and mortar, what are they usually looking at? What are the difference in the mortgage payments, for example? And the type of
You are incredibly bright. That is a fantastic question that almost nobody ever asks. That's a really good question. And there is a significant difference in the loan, and most lenders do not like to do them. So the manufactured homes, they also have a shorter loan term depending on the age of the home. So I think if they're new, they'll go up to 25 years, and then depending on how old it is, you can get up to 15 years. The interest rate is typically higher, a little higher. So I've seen 5 1/4, 5 3/4. And there's only a set number of banks that'll really fund those types of homes. And if it is a brand new manufactured home, they do not work with realtors. So the buyer is on their own. If it's a resale, then yes, they're using the MLS and they will work with a realtor, but then the challenge becomes the lender. And if someone wants to buy one of those and they're comfortable with one of the lenders that provides those loans, then great, that can be a win-win. But you're a little more limited in what you can do, and they don't accrue value as quickly as a brick and mortar.
Right.
Yeah.
So Seleka, why don't you go ahead at this point and just kind of share with everyone that's watching with us, or those that'll be watching later at this point, how to get in touch with you and your information. How can they find you and get your assistance?
Okay. Can I put it in the chat?
Yes, please do.
Yes.
Okay.
Please
So
do. Yeah. And while you can say it while you're putting it in there, that's fine.
Okay. So my website is essentially my name. So it's www.seleka, it's SELEKA, Kerr, KERR.com. If you go to my website and register, you will register. And as they shop around, anything they save, I will receive an alert. You can message me through that. And it will get to me and I will happily engage them right back. The other thing is that if they're shopping and they want to look at homes, you can look at anything on there, and it's better than a Zillow or a realtor.com because they're not actually using live, what's called MLS, the multiple listing service, where all of the homes are put. They're not pulling from there. So they are actually companies that buy data. They're not brokerages. Although Zillow was shifting to become a brokerage, but that's really how they got started, was buying people's data, and they decided to just put it out there and so that the public could view it. But what they're getting is more data to track people. So they figure out how to sell to you as well. But my site is like me going on and looking in the MLS. So what they see, if it says it's available, it's available. If it says it's under contract, then it's not available, but it'll still let them see it.
Wow, good. Gina, anything?
Wow, I think we have a lot to kind of digest at this point. So Seleka, thank you so much. Those who want to reach out to her, the website is there in the chat, and make sure that it gets posted in the comment section on Facebook and on other sites as well. Thank you so much for being here. I know you'll be back because I'm going to go through all of these notes and come up with other questions, I'm sure. And we'll keep an eye on the feed because this is going to be out there. It's evergreen. So we'll just keep an eye on all of the questions and comments that come in. and
Okay.
we'll let you know. You'll be able to see it. You can respond, and we'll respond as best as we can as well. And if we don't know the answer, we'll send it on to you as you know.
Please.
So,
I
but
love
thank
it.
you so much for being here.
Absolutely, it's my pleasure.
Well, definitely to everyone, please thank everyone for being with us. Please like, share, subscribe. Please go to Seleka's website and looking for a home. She's the expert. So that's what we're doing. What this whole platform is about is it's all about working with individuals that look like us, getting that information out there. We're working to build our communities, make them stronger, and we're working together. She already has her platform, but Black Digital Media, the reason of Black Digital Media is this is a platform to work along with other individuals' platform, and we just work together. Our thing is educating our community and talk to wealth building. That's what we want to be about. And so, Seleka, thank you so much for being with us. We're looking forward for you to be back. We'll make this situation much more available, and we're looking for your input, your support to helping us. And so again, thank you very much.
Thank you. My pleasure.
Thank you, Seleka.